Hey, good afternoon. Gary McCarty, the Indie Wealth Coach, with a coach's tip for you today. The coach's tip today is avoid losses. Uh, this is going to show us here on this chart what gain would be required just to cover from a loss that we may experience in the market. If you'll notice on the middle here in the key points of the chart, which I'm circling here with my mouse, the memorable declines, of course, we had the Dow in the 30s drop almost 90% back in the Great Depression, and there's some S&P changes, and most recently the S&P 500 decline of 2007 and 2009, which was about a 57% drop. In 2008 it was a 40% on its own. But this chart here shows how much the market has to forgive in order to give you back the same amount of money that you had. It's not on the chart, but let's just put this into a real quick math perspective, and then we'll talk about the chart. If you have $1,000 and you take a 50% hit on your current investment, how much money do you have once that hit happens? Well, naturally, if you take 1,000 divided by 50, you will have $500. So if you have a 43% gain or even a 50% gain in the market, 50% gain on a $500 current balance is going to give you a $750 balance. You're still at a 25% deficit after losing 50% and gaining back 50%. It'll take a full 100% gain in the market in order to recoup from a 50% loss. And that's really what this chart is showing, is the impact of losses. Now at the indiewealthcoach.com, we practice on wealth preservation, where we try to help you hedge against the losses or make the losses a little bit less painful by protecting principal. If you would like to learn more about those, visit www.indiewealthcoach.com. That'll be on your screen, and I look forward to giving you another coach's tip. Thanks a lot and have a great day.